Today, we will talk about laggards in the stock market. A laggard is a stock or security that is underperforming relative to its benchmark or peers. A laggard will have lower than average returns compared to the market. A laggard is the opposite of a leader. In most cases, a laggard refers to a stock. The term can also, however, describe a company or individual that has been underperforming. It is often used to describe good versus bad, as in leaders versus laggards. Investors want to avoid laggards because they achieve less than desired rates of return. In broader terms, the term laggard connotes resistance to progress and a persistent pattern of falling behind. As an example of a laggard, consider stock ABC that consistently posts annual returns of only 2% when other stocks in the industry post average returns of 5%. Stock ABC would be considered a laggard. If an investor's portfolio contains laggards, these are most likely to be sold off first. Holding a stock that returns 2% instead of one that returns 5% costs you 3% each year. The reason for a laggard subpar performance is usually specific to the company. It could be due to lost contracts, management or labor issues, or eroding earnings in a competitive environment. How does a stock become a laggard? Perhaps the company continually misses earnings or sales estimates or shows shaky fundamentals. Lower-priced stocks also carry more risk because they often feature less dollar-based trading liquidity and exhibit bigger spreads between the bid and ask prices. While a stock share at $2, $5 or $10 may seem like it has lots of upside, most stocks selling for $10 or less are cheap for a reason. They have had some sort of deficiency in the past, or they have something wrong with them now. A better strategy may be to buy fewer shares of an institutional quality stock that's rising soundly, rather than thousands of shares of a cheap stock. Top mutual funds and other big players prefer companies with sound earnings and sales track records, and share prices of at least $15 on the Nasdaq and $20 on the NYSE. They also prefer volumes to be at least 400,000 shares a day, which allows funds to make trades with less impact on the share price. Here are 3 key takeaways. 1. A laggard underperforms its benchmark, in terms of an investment's returns. 2. If an investor holds laggards in their portfolio, these are generally the first candidates for selling. 3. Investors may mistake a laggard for a bargain, but these will carry excess risk. Hope this would help. Thanks for watching.